Just imagine, guys, you as an investor made massive profits in the stock market. Everyone started praising you. They praised your skills, they praised your timings when you entered in the market, they praised your efforts, they praised your analysis, they almost praised everything that could be praised. But what if I tell you that the successes and failures that you got are not only been contributed by the skills that you possess, but also it has influence of randomness, luck, or the circumstances that are not in your control. Guys, this is the most important lesson given by Howard Marks, the legendary investor and the writer of our book known as Mastering the Stock Market Cycles. So, guys, let us discuss how the investing successes and failures or the profits and losses are not only being referred to or are not only being driven by the skills but also are driven by the randomness, the circumstances that are not in your control, luck, etc. So, hello guys, and welcome back to Equi Edge Research, where we discuss your investments and decode stock market psychologies. So, guys, let us start with the first chapter, that is the illusion of patterns in the real world. So, basically, what I did is I have converted the massive bit chapter into the small, tiny chunk chapters, and then we are going to discuss it with the set of chunks. So, basically, if we try to understand the human mind, it craves for formulas, but the real world does not follow formulas, it follows randomness. You see, the craving of this human mind has not been the story from today or not with the age of now that we are talking about, but it is since childhood. The ability of human mind to recognize patterns. You see, when a child cries, the mother comes. You work harder, you get good marks. If you do more hard work, success follows. Well, these formulas or these set of stangs, they feel logical. And similarly, this we apply in the markets. We say if the interest rates comes down, the markets move up. Or we can say if the company has given good earnings, the stock prices tend to rise. So what we try is we try to recognize patterns and formulas that makes things more predictable. But now Howard comes in between and makes us remind that life is messy. Most of the people, they want to sometimes act the same as they acted before, but they can't do it. Why? Because of randomness, because of circumstances. If we take an example of a cricketer, the best cricketer of India, Sachin Tendulkar. Let's suppose on the first ball that comes to him, he hits a cover drive and that goes straight and hit the boundary and you get 4 runs. The next ball that comes, he hits the same shot, but at this time the ball straight away moves to the hands of the field man and Sachin Tendulkar gets out. Now when we observe this case study, what do we feel? Why we think Sachin Tendulkar failed? He hit the same shot. Didn't we feel he had skills? He had a lot of skills because he made himself so good. So what was wrong? It was randomness. It was circumstances. Maybe he had hit the same ball with the same shot, but maybe the pressure that he applied could be different. The pitch may be different. The type of pitch also contributes. The pace at which the ball was being delivered was different. Or if we try to understand with a different analogy, that let us suppose we gave every year we gave same amount of water at same times to our crops. At some year the rain bless, and on some years the drought almost destroys everything. Why? Circumstances. Think of it like you have built a massive bridge, and at this year the condition of bridge is very good, but next year the level of water it increases, And as soon as it's moved more above and above, the condition for the bridge starts depleting, and the bridge gets deconstructed or gets destroyed. Why do this happen? Circumstances. You see, we always try to find formulas in the real world, but that could be very much good on paper doing mathematics and solving 2 into 2, that is 4, but that doesn't really happen in the real world. The formulas, they make life predictable. The two most important factors because of which people are not being able to be successful and at the same time they are safe. It's because of two factors. The first one is fear and the second one is safety. We know that if we touch fire, it is going to burn our hands, which is fear. We know. We have fear feeded in our mind that let us be safe from that. And the second one is safety. And both of them makes life predictable. We love to have formulas which make our life easy and make life more predictable. But the strong point of stock market, why people make more money in stock market, is because of randomness and unpredictableness. You cannot predict what's going to happen in future, because if you could predict the future, या फिर बहुत सारे लोग इसको predict कर पाते, तो इसमें शायद इतना पैसा बनने की possibility नहीं थी, क्योंकि इस पर्टिकुलर काम के लिए एक पर्टिकुलर स्किल सेट का होना जरूरी है. So guys, in this chapter we are going to talk about the irregular dances of cycles and randomness. So basically in the previous sub lesson what we learned is the human mind, it craves for formulas, definitions or rules that makes his life easy and maybe make life feel safer. But the world, that doesn't follow the formulas, but it follow randomness. So basically guys, if we talk about randomness and also the formulas, the craving for the formulas is not from now, but it's from the Stone Age. The human mind with observations understood that during the day the lions and its cubs, they come near the watering hole, and so the humans avoided to go near watering hole in the morning. When the humans started cultivation, they observed, or with observations they understood that the certain types of crops, they grow nice in certain weather and climatic conditions, whereas the others, they grow in different climatic segments. Basically might happen that some crops may grow very well in spring and not in the fall. So basically what we need to understand is it is randomness. But along with randomness, something more is much more important that contributes the ups and downs or the cycles, that is the human mind, the human emotions. So basically guys, what I want to tell you is the human emotions affect the human activities and makes human activities extreme. So basically if we see a bullish phase, it is out strongly out of the human optimistic emotions that are resulted into the huge rallies, whereas when we talk about pessimism, we have seen crashes. So basically when we are talking about um, when we are talking about cycles, or when we are talking about the human mind or human emotions, a very great physicist always told that it would be impossible for learning molecular physics if the atoms would have emotions. But the market that we are talking about, it's full of people, it's full of emotions. So the next time when you try to look at bullish phase or the bearish phase at extremism, one more thing that our mind craves for is giving or defining the cause for an effect. So basically, if we try to understand this with an example from the markets, if we see the market going at bullish phase with overvaluations, we try to define it by the interest rates are getting lower, and hence the stock markets or the stock prices are getting overvalued. Or if we say about crashes, we can say that the inflation numbers are the reason for the crash, but most of the times it may happen that the reason for this is random. Giving out always reasons for such occasions is not right, or it is unknowable. Basically, we don't have a lot of resources based on what these bullish or bearish phases happen. At the same time, what happens is the human mind has this deceptive mindset that if the bullish phase is moving, it's going to be the same. And that's where the intelligent investors they make money by understanding and heeding cycles. Because things are going to change. The thing that takes birth is going to grow, it's going to decline, and one day it's gonna go die. Basically, if we talk about seasons, we have summer, rainy, winter. But the problem is when we say that the summers are coming and summers will never end. But it is going to end and it is going to be followed by the rainy season in Indian context. So the understanding or the stubbornness of us that the bullish phase is going to continue is foolishness. Basically, if we talk about Howard Marks and what I'm talking to you about knowables, Howard Marks and Warren Buffett had this strong conversation where Warren Buffett makes Howard Marks understand that for any piece of information that has to be desirable must be ticked by the 2 points in the checklist. The first is the information really important? And the second, is it knowable? So basically, if we try to take an example, the Howard Marks mindset or his method of investing includes not taking decisions based on macroeconomy. So the macroeconomy is important, but it's not knowable. You're gonna know it completely, and so he does not take decisions based on macroeconomy. Also, giving you a fun fact, Howard Marks gave 3 stages for a bullish phase. The first stage, when the most intelligent people feel that the markets or the things are going to get improved. This is the phase where if you invest, you will get the stocks on a bargaining amount and you will make huge and handsome profits. The second phase, when most of the people feel that the improvements are happening and are going to happen, and when you invest in this phase, you do not get a bargain but you get values of stocks at fair value and you can enjoy some cycle. But in the third stage, the last stage where the markets had already moved to the overvaluation or at its bullish phase, and if you invest here, you are going to lose money. These were the 3 phases that if you master, you are very much close to become a professional investor. With this, I conclude. Thank you.